Yes. For those of you who didn't see last week's Barron's, which the striking price in last week's Barron's, which I do believe is linked on the Trader Insight page, um, I, I was quoted as questioning whether the Fed put was worth more to the market than the upcoming earnings season. And right now, I would say that the Fed put seems to be winning, but we will get a real world test of that over the next couple of weeks as earnings start to come out in a major way from large corporations. But let me unpack that a little bit. A lot of this, what I would consider, chasing the Fed, following the Fed, comes from an old, well-worn phrase, which is don't fight the tape, don't fight the Fed. I'm going to add the corollary, but nothing says that you have to join in. But right now, everybody is just taking the fact that the Fed did this 180-degree U-turn about 6 months ago and went from a tightening stance to an easing stance. And now we're seeing the markets price in anywhere between 25 and 75 basis points of interest rate reductions over the coming few quarters. And that's a big sea change. The reason for the significance of that is equity markets have more or less followed along very closely with liquidity. There's various ways to measure liquidity. I won't get into all of them here in terms of the macroeconomic ways that you can look at it. But in a broad sense, as liquidity increases, so does the stock market, and the inverse is true as well. So the perception would be liquidity is expanding, therefore let's buy. One of the problems you have now is so much of this is done what I would consider model-based or mechanical. This is something that's worked well over the past 10 years. Models are really not good at turning points, so we have to question whether this is just mechanical trend following or correlation following, or whether this is something that maybe somewhat, the market may be getting ahead of itself. And I'm going to say that there is a much greater risk to the market getting ahead of itself than it did through much of the easing that we'd seen over the last 10 years. Remember, the big easing trend began in the midst of a crisis, and of course the Fed's going to throw money at the situation. At first, it takes some time to get some traction, so there was a negative correlation. We were increasing liquidity, but stock markets were falling. But that's because there were these huge structural problems that needed to be resolved. But let's say once the stock market started moving higher, the Fed was pumping in liquidity. If you track these sort of things, you say, wow, there's a great correlation between increasing liquidity and increasing stock prices. And that goes to follow, right? If you add to the old basic thing would be if you increase the amount of money in the system, inflation follows. We haven't seen a lot of inflation in terms of goods and services prices, but one place we have seen that inflation is in financial prices, i.e. a rising stock market. So people are very programmed to follow this. Ultimately, though, what will a couple of basis points here and there do to corporate earnings? The difference now is we're at the mature end of an economic cycle, not the bottoming process. You can argue that we might be forming a top in terms of the economic cycle. And while it'd be great that the Fed's proactive, one has to wonder how much that's going to help. So it's very important to go into this earnings season thinking, are you buying quality stocks that are likely to or that have reported good earnings and showing good growth? Or are you just buying into a market because we don't want to fight the Fed and don't want to fight the tape? Works great for a while, but at the turning points, that's a good way. You can miss that, and that's something to be very cautious of.